Would you enjoy receiving thousands of dollars each month in passive income? The good news is that you can receive that if you invest correctly and you use the tools that have been created to help you achieve that. In this episode, we get to hear from Charles LeMaire, who is a serial passive investor. Let's jump right in so that you can learn how to add more passive income to your portfolio.
Are you a working professional but struggling to balance the workload of your career, family, obligations, and preparing for your financial future? If so, this podcast is for you. You've spent years learning your craft, and now it's time to focus on your financial future. This podcast will teach you what you need to retire wealthy and happy. Let's dive in.
Welcome to the Retire Wealthy and Happy podcast.
Just as a recap, this show is put together to help you learn financial tips and tricks to build up your passive income. We teach methods that you can also use to protect your wealth so that you can plan to have a better future for yourself and your family. This podcast is sponsored by Monument Real Estate Capital. Monument Real Estate Capital, helping you retire 10 years early through passive real estate investments. On today's episode, we're excited to have Charles LeMaire with us. A brief background on Charles: he was formerly an electrical engineer. He really likes numbers. He grew up in Tennessee and Georgia, and he now lives in Texas. He's been running an investment company for about 7 years. In today's episode, we're going to learn from Charles, who again calls himself a serial passive investor. We'll be discussing certain tools that you can utilize as a passive investor and also some of the potential challenges with these tools. Charles, thanks for being here today. Do you want to take a few minutes and introduce yourself a little bit more?
Okay. I guess it's no secret. I just turned 70, so I'm over the hill. I actually started in the real estate area at age 57, so I'm a very late bloomer. I was perfectly happy just tooling around, playing in the market, and doing fairly well at it. I mean, I'm no wizard, but I did okay. And then my wife dragged me kicking and screaming. She decided that real estate was where she wanted to be. It was a hereditary issue because her father did some of it, so she should too. I'm not sure where the genetics are in that case, but we'll let that go. Anyway, she decided after a short period of time of being a real estate agent that she didn't like working weekends and didn't like making cold calls. And you know how well that went. So she dragged me to a group meeting about multifamily real estate, or actually it was about passive. It's Lifestyles, which is here local in town, or at least they're in Houston and also have an office here. So we went to this meeting and they tried selling everything. We left, came back a few months later. At that point, and if you've never seen the movie The Sting, this won't necessarily make sense, but I counted everybody in the room. I divided that number into the amount of money they wanted from me, and I said they would not be able to hire these people, so therefore we did it. And we played there for about a year, and then their main coach split off. We followed him, and so we've been in the Sumrock group ever since. I like him. He's done a very good job for us. He's been great for us. But it's no, there's no buts in there. He's done just very well. Anyway, so that's the real estate part of it. Before that, I was a kid in Tennessee. I'm a little weird. My father was a tennis pro at a country club. He was a much older person than normal, and a lot of people liked him, and I enjoyed the access to some things at the club, including a lot of people who were knowledgeable about money, wealth, and all this other stuff that we did not have because we didn't have any of that. But I learned, a respect for it, and I learned that it is not scary to deal with. There's money is not a problem, and so I got my Dave Ramsey rules, because I'm actually older than Dave Ramsey. And he wasn't broadcasting at the time I was growing up. So I came up with my own rules. They're similar to his in some ways, but also different. I think he's done some things differently. And so he has some bias, and he caters to people that are bad with money. And I guess I grew up being pretty good with money. So it wasn't a big deal. I don't know. What else would you like to know about this whole thing? Oh, I went to Georgia Tech. I spent way too many years there. My mother was upset about that whole thing because she thought I was a professional student. And I said, well, what's the problem? I'm paying for this, not you. So leave me alone. Anyway, that's pretty much the way things went.
Charles, you said that you were playing around in the market. What did that look like?
Well, let's see. Everybody has a 401k. I started work in 1980. 401ks were invented about 78, as I recall. They didn't become popular until about 80. So, just at the time I'm starting to work, these 401ks are coming on board, and it's only the traditional at that point. And I'm thinking, hey, this is a pretty good deal. Well, it wasn't as stupid as it might sound today, because the max tax rates were running right around 70% at the time. So it really did make some sense, although I didn't make that much. So I've never calculated exactly what I was at. But anyway, the whole game on a 401k traditional is, if you can put it in at a higher tax rate than you can get it out, you win. I'm questioning whether that was a good idea now. So, as rates have even come down by so much, but my income has gone up, I'm not sure I'm winning at this point. But so I'm not a big fan of the traditionals in that sense. But if the boss is giving you, $1 for every $2 you put in, or $1 for every $1 you put in, get that match. The match is good, because that's 100% return, and I have yet to find 100% return on many things. So anyway, I had my 401ks, and it grew really well at the first company. What you'll learn is I can't hold a job. So I changed companies 2 or 3 times over time. And, when I first did it, I rolled into an IRA at Schwab. I like Schwab. And all of a sudden I'm realizing, wow, that's quite a bit of money. I must have done real good, which means they did real well on that one, because I wasn't paying any attention. After that, the second company, I started doing it again. And by the time I got to the third company, I was a bit older. Let's say I hit about high 40s. Excuse me. And I started saying to myself, somebody ought to pay attention to this stuff, because I'm not, and, nobody's going to be looking out for me at some point. So at that point, I started turning and looking at these things, and I decided to study stocks. I found that I'm not very good at it. So I studied index funds, and I got to be reasonably competent. And so my claim to fame on that one is, for the last, 5 or 10 years of where I worked, I was essentially beating the TI 401k about by 50%. If they did 10, I could do 15. If they did, I'm going to screw this math up. If they did 5, I was doing 7.5, and I'm not going to go any further because I'll mess them up. But essentially, I was beating almost all of the 9 blocks. If you've got the cap sizes, large, medium, and small, and then you've got the value blend and growth. So if you look at the 9 blocks, I had something in each one of them. The only one I couldn't beat was the value large cap. They apparently had a pretty good fund on that one, but I was beating the others, and very, very happy to do so, and continued doing that through my time there. I also decided that after doing some math, I discovered or heard about or realized that there were these things called RMDs. And I said, hey, now, wait a minute, this is going to be a problem. And I started calculating a little bit, and I said, whoa, I want to not be in the RMD world. So I started backing off just down to match, and I was happy to do that. Luckily, I did that soon enough that it gave me some money on the outside of my 401ks and IRAs, that I was able to put real money, my money, into real estate rather than IRA and 401k money into real estate. And I'm a very strong proponent of putting your own money in rather than retired money, with perhaps one exception. But essentially, I like money outside of retirement funds going into real estate much more than I like money going into real estate that's inside retirement funds.
Charles, you're talking about a lot of great things, and I'm wondering if we need to narrow them down and talk about each one individually so that our listeners can understand. Roger, do you want to go through and ask the questions, or do you want me to do it since you're not feeling well?
Are you talking about these questions under the topic? Question 1?
Yep. Because he's talking about several of these items.
I think the most important thing is, what is the most important thing? Because we're talking about traditional being good if the employer matches.
Well, today you can match and throw, the match goes into your traditional, but everything else goes into a Roth if you want it to. So you need to look and see what's your tax rate, and if your tax rate is huge, then sure, take the win and just not pay as much taxes, but figure on somehow getting it out later at whatever lower tax rate you hope you can get. If, on the other hand, you're younger and you're starting out, your salary's not terribly large, so that you are not precluded from doing an IRA, or your tax rates are not too high, go Roth, because I mean, it's a foolish thing. Today we have the lowest taxes that we've almost ever had. There were a couple of years they had some slightly lower ones than today, but we're at almost historic lows.
What were you saying about how you use IRAs and 401ks with real estate? Were you saying you don't like that, or what was your comment?
Okay, you got to do a box, a 2x2 matrix, and you put IRAs at the bottom, 401ks at the top, traditionals on the left, and Roths on the right. If you do an IRA and you put that, it'd be a self-directed IRA at this point. If you put a self-directed IRA into multifamily, which is what I do, syndications, they sell those far too frequently. Essentially, they're flipping apartment complexes. You never sell the thing without a huge mortgage on the thing, and realize that UDFI, or UBIT's ugly stepsister, will tax you quite a bit on your gains whenever you sell. And so, yes, it's in an IRA that's not taxable, except that it is, because you get a chunk of your gain disappears. So that sort of rules out the IRA, both Roth and traditional, because they take such a big wallop. Now, Roth is better, but, they both get walloped by that. So then you can try to go to a solo 401k, which skips the UDFI. So you push your money up from your traditional into your traditional solo 401k. Well, at that point, and this is true of all traditional accounts, if you make a ton of money in your traditional, all you'll end up doing is having a ton of RMDs later in life. RMDs are bad. So
Charles, you've used RMD a couple times. I know what it is, but will you
required minimum distribution? Used to be at 70.5, moved to 72, and is moving to 73. So at age 73, I will have to take out approximately 3%. At 74, I'll have to take out, I think it's 4%. Anyway, at 74, it'll be 4.25%. At 75, it'll be 4.5%. I'm making those numbers up, but essentially it keeps growing until as you get older, because that's how much time you have left. And at some point, you have to take out 40 or 50% of what you have in that bucket. Well, given just the mathematics of your account growing and you taking out a lot of money, it pushes you up the tax curves, the brackets, if you will, painfully so. And so you can't stop taking the money out because you have to remove it. And if you could give it away and avoid the taxes that way, or you can, usually it just throws you into the tax rate. So if you want to control your taxes as an old geezer, you want to move that money to a Roth or out of the traditional device, no matter what, so if you cross the boundary at $1 million, you're going to be pulling out $40,000 approximately the first time, and then slightly larger ever since then. And that'll throw you up those curves, in a painful manner, because then you're also putting it against Social Security, if it still exists. We will question, old people vote, so there will be something. I don't know what it will look like, but there will be something out there, albeit probably dumber than it is now. So it's just a problem. And then if you're a married person, there's this thing called widow's tax trap. Google that, read up on it. But essentially, when one of you passes away, you lose one of your Social Securities, the lower of the two. You keep all of your RMDs because, husband gives it to wife gives it to husband. In all, financial meetings, they kill off the husband first. So I'm gone. My wife gets it, and she has the same money that she has to pull out in RMDs in total. So in lower tax brackets, so boom, she goes up much higher in tax rates all of a sudden. So you leave that present for your spouse or widow at this point, and they have all these tax problems in the future. Not a good thing. So anyway, that's why I don't like putting a ton of money today, now that I've realized it, into traditional retirement accounts, because it will force you to pull the money out later. Another piece of this thing is IRMA. IRMA is your fancy thing for Medicare. If you're just a normal old Medicare, they put this into place a few years ago. But if you're doing really well, and people that are going to listen to this podcast are typically going to be successful. So if you're successful and you put a ton of money into your traditional IRA, 401k, and you have to pull it out, all of a sudden that counts against your income. Your income goes up, and they're very kind about this, but they let you pay more for your Social Security. How nice, not Social Security, Medicare. For Medicare, So you get to pay not the $170 today, but perhaps as much as $350, $400 per month per person. I love that. When I was at TI, I was paying maybe $100 a month, and then maybe that was a half month. I don't remember, but that was for both of us, and we had great medical care. And now I get to pay nearly $400 a month for each of us, so that's like $800 a month, more or less. Shazam! Aren't I lucky? But I get the better doctors. Better appointments. Nope, not that either, but I get to pay more. They do let me do that.
So, Charles, I'm hearing you say that there's benefits for using retirement accounts, but a lot of those benefits are in the here and now. So like we might be saving some on our taxes now, but there's also the consequences that a lot of people don't talk about, as in when you actually retire, you're in theory forced to take out what you're calling required minimum distributions. You're forced to take out some of that capital every year, and it goes up as you get older. And when you take that money out, you're getting taxed on the money that you're taking out. Am I understanding that right, Charles?
You are dead on. And it also causes, it is likely that everybody on this call will already be above the Social Security numbers. But if you happen to be a lower income person, if you happen to get these RMDs and they're big enough, they will push your Social Security into taxation, because you normally can pay 0 at a low rate, 50% at a somewhat higher rate. Nobody I know is going to get to 50%, but by and large, it could happen. But as you go higher than that, they push you to 85% of your Social Security becomes taxable. And the mathematics push your tax rate to 49%. Instead of the 22% in that bracket. There's a small area where you're paying a 49% rate. Oh, thank you, Mr. Government. And while you're doing that, they get you to pay more for your Social Security. More for Medicare. I keep going the wrong way on that one. It gets very confusing. It is a compromise all the way around. You're having to fight one side against the other, get the money out one way, and pay fines and fees another way. So there's both these fees and the taxes that you're having to balance to try and optimize your way through life. And sadly, because you don't know what the future is, you can't really optimize. You can just do the best you can. You take a shot at it and see what you can do.
Before this call, you had told me about Social Security taxation. You call it the tax torpedo. Are you talking about that right now, or is that a different thing?
No, the tax torpedo is where if you pull out money and move yourself from the 50% bracket to the 85% bracket, you're typically in the 22% tax bracket, but you're moving 50% of your Social Security money was taxable, and you're moving up to 85% of your money. So I take $1 out of my IRA money, my taxable money, and $1.85 becomes taxable by taking the $1 out. So it forces the taxation of $1.85 for every dollar I take. And that moves your effective tax rate to 49%. Tax torpedo.
That sounds painful.
It's damned inconvenient. Thank you very much. Now, a lot of people are above that anyway, and it's just the fact of life. It's already done. You're above that. You're back into the 22, 24%. But there's a little cusp right there that if you live in that cusp, it becomes very painful, because every time, your air conditioner goes down, your car needs repair, you take $50 out to do something, and you're paying tax on, I can't do the math. Sorry about that. Take $100 out to do something, and you're paying tax on $185. So, what the heck? That ain't fun.
So, Charles, in this episode today, we're talking about tools that you can use to help with being a passive investor and some of the challenges. It sounds like the challenges are that when we get older, we have less control on how the taxes impact our situation. So I think a question we should be asking you, because you're very intelligent, you've done a lot of research on this, what are some of the best strategies to be using so that you can minimize those, we'll call them consequences, but whatever word you want to use?
Well, I would say go Roth as best you can. You want to pay taxes on capital gains. They may change this, and bite me in the wherever someday. But essentially, your capital gains rates are much lower than your income rates. So if you have a choice of receiving income or capital gains, take those capital gains, because that's a much better choice. If you can pay the tax ahead of time when it's cheap, for instance, today we're in the Trump tax period, we will jump all of the rates 2 to 3, 4% here coming up in the next couple of years. So if you have an opportunity and it works out for you mathematically, move some of the money that you've got in a traditional to a Roth. Now, and we're mostly talking about real estate here. So I have some qualms about telling anybody to do anything in that for real estate. But say you have a solo 401k. The solo 401k, if it's traditional, you're going to be taxed with that RMD. But if you can move it over to the Roth, the RMD disappears and you have free money from that point on. It's a, tax the seed corn or tax the crop at the end kind of thing. And you got to do the math on what to do it. As long as you're moving reasonably small parts of your money, then it probably makes sense to put it over there. The problem is a guy's working for, a bunch of years and he has $2-3 million and he's got from age 65 when he quits work up to age 73, or it will be 75 at some point. He's got a limited period of time of low income. Realize during that period of time, as soon as you hit 63, you're messing with that IRMA. Medicare kicks in at 65. They look back 2 years and say, what did you make then? And that's when they set your IRMA. So as soon as you hit 63, that IRMA number starts being calculated. As soon as you, I guess the next big one is at some point between 62 and 70, you take Social Security. So that uses up some of your income that you no longer have available at a lower tax rate so that you can move money out of one device, traditional, into Roth. It's a balance. You just got to, sort of plan all these things on your balance. But on the other hand, if you're invested in real estate, that doesn't really pay much taxes until you sell it. And if we have right now, you have these great depreciation things when you sell it, or if you own it outright, a house, if you're into single family, you can play 1031 exchanges, and those things work great because you can keep pushing off your gains for a long time. You can live on borrowed money. You don't have to actually put all the money back into the house. You can take the loan and then live on that kind of thing. And I'm not saying, high interest credit card debt. I'm saying, the low interest mortgage kind of things. And then there is the trick that you can do the step up in basis at the end. The side effect, of course, is you're dead. So there is that small problem. But by and large, we all do die. But it's nicer to hand your family all of the money instead of just 60% of it because the government took 40. So there is that little game in place. Now the single family, or what I'm doing is syndication. So if in fact in a post Charles world there is the step up in basis in my, I don't know who that was, and we don't want to talk to them anyway. There is a step up in basis when I get out of it, but we do sell these properties fairly often, and I do have to pay some taxes along the way. It's just the life, but the gains are so good, I'm not giving it up. I like it.
So Charles, a couple of times you talked about your investments in multifamily, and you've also talked about being a serial passive investor. So I'd like to know a little bit more about what it is that you like about multifamily and how you're using that as an investment strategy. Because there's a lot of different people that we have in our audience, and I want to understand what you're doing as a passive investor and how you look at it.
I think most people who do this kind of stuff want to be the lead. The lead makes, or GP, they'll make a lot more money than I will. They have the possibility of making infinite return because they're making money on other people's money. OPM is always good. I am, as a passive, I'm limited on, the return on my funds. But we make enough. I'm not a megalomaniac, so I don't have to conquer the world. And I have so much more than I ever expected to have, having done this. I'm not worried about that. My wife might like me to be more worried about that and make more, but by and large, I'm a happy camper. So, we have what I'll call plenty. She won't, but that's okay. But we've done a bunch of them. We had some money to start with. So, if you have money to start with, you can play as an LP and continue that way. I talk to so many people and they go, well, that's what I want to do when I grow up. I want to just be an LP because there's a lot less stress. I don't have to do any work really. Well, I have to meet people. I have to judge if I like them. I have to bet on that, on the jockey, as it were. So, there's things that I have to do. I have to be knowledgeable how it goes, but then I'd have to do the same thing in the stock market too. I'd have to spend time learning about, in my case, mutual funds, the guy who's running the mutual fund, again, bet on the jockey. So, essentially I have my tasks, but I don't have day-to-day business activities on the apartment. I don't have to make big decisions. I can be out of town. It doesn't matter. If we have a fire, and God, I always hope we never kill anybody in these fires or maim anybody in these fires, but the property manager is going to know about the fire almost immediately. The asset manager, the lead GP on the property, is going to learn about it an hour later, and they're going to be all fretting on having to deal with the insurance company. I'm not. I'm going to hear about it in an email probably the next day. I'm probably going to see some pictures about how bad it was. And if nobody was hurt in the thing, I don't have to feel any guilt. And then I'm going to say, well, that gives us the opportunity to rebuild back a better apartment and test higher rates. That's the way it works. And if in fact it's out of service for a few months, they go, oh my gosh, we're not going to get any rent. But yet we have an insurance policy that will pay us. So we're not going to lose really much rent. Now, we won't see that money for 6 months, 8 months, a year. But it'll all come back to us later in a bigger check at some point. So it is not a big deal. I will add that in my world, in multifamily syndication, passive investing, they will tell you that you're going to get, this kind of cash on cash return. I'm not going to tell you don't believe them, but I'm going to say don't depend on it. It is not what I'll call eating money. It's vacation money. Because if you're going to eat on this, you're going to be a thin dude many times. You're just not going to see those checks come in and you're going to be hungry. But so far, whenever we sell the place, we typically do okay. And I mean, okay is really okay. So, I see people go, how can I make $10,000 a month? And I'm going like, I got no idea how you can make $10,000 a month. I know how you can make $1 million a year, but I'm not sure how you can make $10,000 a month. I can't figure that out. So it is, it's a confusing thing, and when they talk about what's your income, I don't know. I won't know until the end. Now, there is the issue, and I'm probably going far afield, back to taxes in a sense. It is just the biggest pain in the popo, and by that, you know what I mean, about selling the place. I know when I'm going to invest in a deal. They may or may not buy the deal in a timely manner because sometimes they delay, and they choose to sell the deal sometimes at an opportune moment and sometimes at an inopportune moment. If they sell the deal on December 20th, I don't have much time to get another deal with that money, so it's going to be the following year. So there's always issues like that. And if you've got your taxes all planned out, you've got your payments in on time, and all of a sudden they sell another deal at the end of December, you go, oh, well, darn, I'm going to have to play some games here to get my taxes to straighten out again. So you have little control over that. So there's frustrations. But so far, I can deal with those kind of frustrations. It's, just life and laughter when it comes down to it. But it's just, you throw more money at it. What the heck? You can handle it.
I mean, dealing with taxes, that means you're making money, right?
Typically so. But, you don't want to send it to Uncle Sam if you can help.
That's right. Now, you've used the terms GP and LP a couple of times. In case our listeners aren't familiar with those terms, that's general partner and limited partner. Limited partner is somebody who's a passive investor, and that's what Charles is here. Now, Charles, before the call, you would also...
If I may, LP actually stands for lazy person. Just to point that out. And that's what I am. So go ahead.
Well, but smart at the same time. Obviously, you've put yourself in a good position. So
yeah, okay.
You've earned the right to be lazy. That's okay.
I have a question.
Sure.
Have you ever been an operator?
I have been suckered into operating, I guess, 2 or 3 times. And they're part of my, horror stories. And I tell horror stories because I think people need to know what's real. But I'm still doing this. So, you just work the problem whenever you have these things. On one property early on, there were 5 or 6 of us invested. And the GP's wife had some medical issues that he needed to take care of her. The other people invested on the deal said, Charles, tag, you're it. And so I operated the deal for about 6 months on that one. It was a property that it was struggling. It was not the normal thing that we buy. It was sort of speculative because I figured it was 3/4 of a mile from a lot of new building going on. And I figured as that new building approached us, our price would go up. And so I sort of had some good feeling about that. But we had trouble with our property manager. We thought we had that all worked out. And then the guy we had planned when we bought the thing said, oh, no, I'm not doing that. So we had to struggle around and get a new property manager, and they were lousy. The rest of the team thought that, the rest of the group thought they were stealing from us. I did a lot of math. I don't think there was enough money to steal. I think they were just such bad managers. They weren't doing very well. We had just gotten a new manager, and it turned out she was quite good. And then, my buddy's, his wife got sick, and I took over. So she and I walked the property. We were going to do it on, I'm going to say it was a Tuesday, but there's an ice storm, so we had to wait a week. Then we walked the property. Dallas has ice storms. How fun. Anyway, we walked the property. We had some roof problems, and there were 4 big down units, and they were costing us a ton of money just sitting there. And by costing, we weren't making anything. So I said, how much to get these up online? And, there were other issues also, and she just didn't have any money because we weren't making anything. We were at low, we were around 70%, 65, 70% occupancy at that instant. And she said, well, I got no money, but it'll cost about $5,000. I wrote her a check, said, get them up online. Within 8 weeks, we were at 100%. And we were starting to make money, but not enough to dig us out of the hole we had gotten into. So I did a cash call. It was the first and only cash call I'm aware of, and I did it. It was 8%. Everybody had to pony up a little bit more money. And we ended up selling the thing. And these are old numbers. So we made a ton of money. It ended up being a 45% IRR, internal rate of return, if I needed to find that. And that is essentially a return that takes compounding into account. And so it was a wonderful deal. But, you'd have to say that we were struggling. And we probably could have made a little bit more if the darn thing hadn't been not doing very well for a year and a half. So anyway, yes, I had to run that one. Same fellow, sadly, a few years later, we were in another deal together, and he'd gone to Mexico, had a great time, came back, and then ultimately had a heart attack. They thought he was about to survive, and then he didn't. So he and I were the only real investors, my wife included. And so I had to take over that property and run it for a while. His estate wanted money, so we ultimately sold it. And so that worked out all right, too. So, yeah, I've done it. And, that one made money, too. I think we made about a 29% IRR on that one. Again, old numbers, don't expect these numbers at all times. Your mileage may vary. Let's see. The other time I was these guys needed more money to get this property bought. So they offered me a small percentage of the GP split. And said, if you'll put in more money to begin with and loan us a bunch of money up front, we'll pay you this much. Part of it being this portion of the GP split. And I went, okay, sure. So I was a white knight owner on that one. And I think there was one other time, and I'm trying to think of what it was. I can't remember off the top of my head. So, yeah, I've done a little bit of it. Never bought a property, sold a property, but and operated a few. But it's not my game.
Would you say that operating takes quite a bit of work, Charles?
Once you get it stabilized, no. But to get it stabilized, yes. I think it's more work to buy the place because there's so many moving parts to get it bought. Once it's bought, there's a fair amount of work if you're doing a value add to get it up and running. Once the value add is done, I think it coasts pretty easily. So, it depends on the phase you're in. And then selling it takes not nearly as much as it takes to buy it, but it takes some effort to sell it because you got to make some decisions and do some things there. But it's not a full-time job by any stretch of the imagination.
Roger, did you have other questions?
Nope.
So, Charles, before the call, you had made a comment that you don't like the usual general partner pitch to new limited partners. And I'm really curious to know what you meant by that, because I think it could help a lot of our listeners. Okay.
I find there are 2 things that I find just a little bit disingenuous. That's my way of saying sort of crooked. So one of the pitches today, and this is, I guess people will listen to this, I don't know if you're putting it on YouTube or not, but in 2023, 2022, the big push, and even a little before that, the big push has been bonus depreciation. The cost seg leads to the bonus depreciation, and you'll get all this depreciation when we buy the place. And, that's nice. I put in $100,000 and I might get $60,000, $70,000, $80,000 worth of depreciation. But if I'm not a real estate professional and I don't have houses, I don't have other things. I'm an absolutely new person to anything with passive income. All that depreciation does is go into the bucket, sit there until I sell something, and then it gets pulled back out of the bucket to be used. So if we didn't do it, I would essentially be in the same place as if we had done it. And so all I've really done was pay for the cost seg so that the people who are real estate professionals and the GPs on the deal, so that they can get the bonus depreciation. I mean, that's been my job, is to fund their depreciation. And I just, for them to oversell it like that seems a little bit disingenuous to me. They could at least tell people that, sadly, you're just, it's too late. You're not going to really see much of this depreciation. You'll come out about the same. It will cause you not to pay taxes for the entire whole period. That's a true statement. But it will really just return you to what your sales price was. It raises your basis back up rather than, doing you any particular good. Good tax savings is pushing taxes off till later. You're not doing that with this, or paying less. And you're not really doing that with this either. So the bonus depreciation doesn't help you much for a completely new person. I'm not a completely new person. It helps me a lot, but I'm not going to lie to somebody who's getting into it so I can make more and they won't. Sorry, it ain't going to be there for you when you get there. It not unlike Social Security. I'll pick on them. We're screwing the young people on this thing. So, we who are older have made more than those who are older. People older than me had a better deal than I have. Sadly, that's the way things work sometimes. The other part of it is the GP-LP relationship is that of sharks and chum. I am the chum, they are the shark. And they're looking for me, and they want my money, and I know they want my money, but sometimes people are new and they don't realize how much they want their money, and they do need to collect money. They need to get it in there. The deals are good. They're going to probably make a profit. No guarantees on this stuff, but they will tell them how wonderful it is that you can take your IRA money, move it over to a self-directed IRA. Often it is a traditional at that point. Sometimes it's a Roth. And they will tell them how wonderful this is, and they can do that. Well, but they rarely ever mention that little thing called UDFI. And UDFI is often mentioned to them about year 2 in the deal about, oh, by the way, you're going to get to pay taxes on all that money you make on this thing. So let's say the deal goes really, really well. And it has, oh God, if I can do numbers in my head, let's say it has an 80% loan. You put in $100,000 and it's going to make, it's going to double your money in 3 to 5 years. So poof, in rough numbers, in about 3 to 5 years, when you sell the place, they'll hand you back a total of about $200,000, some of which came to you over time, some of which came to you at the sale. Well, 80% of that is now taxed at a fairly high rate, somewhere in the neighborhood of 20 to 40%. And so you could end up handing back a very good portion of all this wonderful gain. And so you sort of question yourself going like, why am I in the real estate? Because I just lost all this stuff. The other problem with IRAs is that you don't get that depreciation along the way. And, sometimes if you buy your second property, if you sell a property in parallel, again, the new person it will matter to, but the person who's been in it playing for a little bit of time, they do that, and then they lose all that depreciation. So what they've done is they turn that $100,000 that would have been capital gain into earned income sometime in the future. And it will probably increase in, you wait 10 years, it's going to double or triple or quadruple or whatever. And they get to pay income taxes on all that money that they've done because they did it inside of an IRA. Now, if it's a Roth, the second part goes away. If it's a solo 401k, traditional, the first part go away. And if you're in the sweet spot, if it's a solo 401k Roth, it all goes away. So, if you can get your money up into that other one, although you have to pay taxes to get it there, that one I can wrap my head around putting money into a real estate property. The only problem then is RMDs have gone away for Roth. Roths are no longer RMD'd. One of the problems with a traditional, though, if you have it in if you have it in an IRA or the 401k is the bigger problem. You may aggregate all of your IRAs. And that means that if you have 10 IRAs, you can add them all up, take whatever you need to send the government or pull out and pay taxes on. You can pull it out of any one of them. But when it comes to a 401k, you have to pull the amount out of each one of them. So let's say you've got that house that you put into that 401k and you don't have a lot of cash sitting in there. The IRS is not very amenable to you pulling a door off the house and sending it in, saying, here's my taxes. Yeah, they may take a window or something, but it's inconvenient. You got to have some cash in there to get this to work real well when you hit that RMD age. So, just be aware of that if you're going to play in that market. Luckily, the rule on Roth 401ks has changed. They used to have RMDs. No, they no longer do. So you can win in that box. Remember my little quadrant of 4 boxes. The upper right hand box, the Roth, and the 401k, it wins.
Charles, I really love what you're talking about here, and you're very intelligent, so you understand everything. I want to bring it down slightly simpler for anybody who's more of a newer investor.
Sure.
Our podcast is called Retire Wealthy and Happy, and part of getting to that point is obviously creating income and creating wealth for yourself. But a lot of the things I'm hearing you talk about, correct me if I'm wrong, is taxes and how to properly plan for that and try to minimize them as much as possible, because you can make a lot of money in this world, but if you're paying a ton of it in taxes, then it's not really helping you. So these IRAs, 401ks, these are all tools that we as individuals, as investors, can be using to minimize our taxes. But we also have to be looking at the bigger picture, which we probably want our CPA involved in that conversation, is that when we get to the point where we're using it, or even right now, there's consequences for each different type of retirement account that need to be taken into consideration so that we're not, for lack of a better word, shooting ourselves in the foot down the road. Would you agree that a lot of what you're talking about is tax savings in some aspect?
Oh, yeah. I will say that a CPA is mindset to save you money this year in your taxes. And you probably want to discuss some of this stuff with a financial planner, a good one who has, fiduciary, that you love that word. Although, the government recently has changed the meaning of that to ESG, and I'm not real thrilled with that thought. But in any case, you want a good financial planner to actually talk about future taxes and planning them out. And, if you're, I took a class, I'm just weird. I take these kind of classes for fun. And you can pay zero tax. Of course, you're not making a whole lot of money on this thing, but essentially you can jury rig your life up where your Social Security, all that you make stays under a certain level. You put everything in Roth and, you've prepaid your taxes and you can live through retirement at zero tax. And I went to the class and said, this is nuts. You won't have much money to play with. So I chose not to go quite that route. But then I started calculating and going like, well, yeah, but I don't want to overpay it either. So, I want to have a whole lot more, but I want to pay a much more reasonable amount of taxes than I would have. So taxes are a concern, but you shouldn't let the tax tail wag the income dog either. I mean, you should make what you can, but try to moderate the taxes that you have to pay that's on it. Don't be completely tax nuts. I sound like that because I feel so many people put no effort or have no thoughts about this until they hit, I don't know, maybe 65 or so. And then all of a sudden it becomes almost too late if you haven't started planning on this stuff. When I retired, and, I am 70, I retired at 65. For the last 5 years, some of the old geezers, we'd get around and just talk about things. And this one fellow joined our conversation. He was about a year from retirement. And he said, where do you learn any of this stuff? I've never heard about any of this stuff. And we're thinking, the dude is 64 and he hasn't planned one bit about anything to do with retirement. He had a pension, so he wasn't going to be, with no money, but, he hadn't spent any time, learning about some of the facets and features and the confusion of how Social Security works. It's a pain. They win the Olympics of confusion. How Medicare works, they're coming in second. Taxes is a close third on any of this stuff. You got all these things, coming to bite you when you get older. And if you got no money, none of these are a problem. But this being rich is a real pain in the popo. Sometimes you gotta either think about it or understand it, or just pay the piper. One of the three. I don't know. But
well, and that's kind of the point of this episode and this podcast, is to try to educate people on things that they should be thinking about, hopefully before they actually hit the age of retirement, so that they can be planning more appropriately. So it's great to hear your perspective on all these pieces. Because you've obviously done a lot to understand them and apply them into your own life. Roger, you doing okay?
Yep. It's all right.
It's okay. Any comments, or you want me to keep going?
I have a couple of follow up at the very end. So,
okay. Let me ask the next question then. Charles, one of the things you had said before this call was it's the responsibility of the investor to be sophisticated. And you also mentioned that it's people that are offering investments shouldn't be tricking people, which I 100% agree with. But the question I want to ask you right now is, what could somebody do to become more of a sophisticated investor if they're going to be passive? Because there's obviously questions that you're probably asking the people that you invest with, that you're able to try to establish trust with those people. I mean, you're very sophisticated. What would you suggest to somebody who doesn't have much experience investing passively? What should they be looking out for?
I think, there's a couple of avenues. I think you can learn in many ways. We went through Brad Sumrock's group and lifestyles before he split off of it. And so, I take things somewhat seriously if I'm playing with money, and I put a lot of attention into how it all works. But I think a person who is only being a passive could easily become sophisticated simply by reading books, by hanging around at a lot of meetups. I don't think they become sophisticated by jumping in and sticking their money at risk until they know something. I think that's a bad idea. We usually laugh and say the government in the SEC rules protects the stupid and the poor. So don't get ahead of your skis on this thing. Get a book, read it, sort of understand what you're going. A couple of them I mentioned earlier are good primers on the subject. And then go to a bunch of meetups. If you're lucky, there's some in your area. They typically are everywhere. I have to admit, Dallas-Fort Worth is sort of the hotbed for this stuff. So, I don't have trouble finding a meetup, every weekend and most weeknights, and I'll go to a few of them. I tire of them sometimes, but by and large, they're all over the place. But you can meet people there, and there are, nice people, not unlike myself, who will be happy to discuss things with you. And I rather enjoy my position as an LP. I'm not after anybody's money, so I do not fit the shark mentality. I mean, if you're talking to the shark, do be aware that they have their interest in your chum. But if you're, but they'll usually tell you all the stuff about it, and they'll tell you good things. On the other hand, they're trying to, fund their deal, and they want your money. So, meet, listen, and take everything with a grain of salt, and then keep going to these things. Once you're ready, start. Put your name into all the buckets that you can. They start sending deals out via email. Look at the deals, listen to the presentation about the deals, sort of understand how the deals work. I would always suggest don't jump into the first one you see. Look at 2, 3, 4 of them and see what they're doing and see what makes sense to you. And, you'll have a style perhaps that you like. You may or may not like single family. You may or may not like multifamily. You may or may not like storage. I saw one on ATMs recently. I'm not a big ATM person. You can do mezzanine lending when it comes to some manufacturing facilities. You can actually buy manufacturing facilities. Owner of building sells it to you because they want the depreciation, or they want to get they want to take the rent off their books instead of the depreciation off their books. So, I mean, there's all sorts of games people play. And most real estate, if you're dealing with a good GP, will come out profitable. But there's RV parks and trailer parks. Those are another big set of these things. There's all sorts of places that you can put money in real estate. Oil and gas. I don't do oil and gas. I can't speak to that, but there's all sorts of things. So keep your mind open, whatever is good for you. But it is a world out there. I've introduced, 20 or 30 persons that I worked with into this stuff, and all of them have come back and thanked me, so it's an eye-opening event. I had no idea any of this stuff existed until I started hanging around in this thing. I will say, before we did this, there was a fellow across the hall. This would be about 85. And he bought and sold hotels. We had a hotel office kind of system. And so it was all these unrelated businesses. And I just found it a little bit fascinating that he was buying and selling these hotels all the time. And I thought, well, that's just really interesting. But, he had apparently a ton of money somewhere, because in those days you had to have the ton of money. the agency sort of opened up the floodgates. I gather it was around 2000, late 90s, early 2000s, when you could start doing these syndications with more normal people. And, so I lucked out getting into this, started in 2010. But it's a fascination. But, open your eyes, look around. They're not all charlatans. There might be a few of them, so keep your eyes open. Don't just jump into anything. But, it is possible to make money doing this stuff. They're just not out there to screw you because they need the money to do the down payments.
Charles, thank you for sharing those comments. Is there any, and you don't have to go into details to answer this question, but is there anything specific that you look for in a deal that you want to see if you're going to invest in a project?
The first thing I look for is the jockey. In our group, we have perhaps 1,000 or so active members at any one time, and a bunch of new members are coming in rather often. And so my whole thing is that I will meet people in that group and I will get to know them. Once I get to know them, and I think that they have a certain amount of dignity, a certain amount of integrity, a certain amount of financial acumen, then I will start thinking about what kind of deal thinking about waiting to see when they get a deal. I want to be on their list. They'll get a deal, and I'll look at it. First of all, I have to have money. If I don't have any money at that time, I may look at it, but I can't do anything about it. But if I happen to have some money in the bank at that point, they will have a property. It's 100 units, it's 200 units, it's 250 units, something like that. It's in a location that makes sense to me. It doesn't have to be in a particular place. If it's the GP, he should probably be well acquainted with the area that he's operating in. There's a GP that operates perhaps in Nashville, and he might get a little bit around Nashville, but he's probably not going to be very good at operating in Dallas because he doesn't know anything about Dallas, or vice versa, or North Carolina. But once I find a GP wherever he's operating, I'm fine with that. I'm only providing the money. He's providing the knowledge about what's going on there. But I have to trust him on his underwriting. I have to trust him on his selection of a property. So that's where the integrity comes into me. I try to go buy the properties, but if they're too far away, I'm not going to do it. We invested in a property in Hilliard, which is outside Jacksonville, Florida. I knew the two guys that were doing it and got along with them great. And it came out, being a really good deal. We sold it last year sometime. There's a property in Athens, Georgia, and the guy who's doing it is doing a wonderful job on the thing. It's a 300 plus unit apartment complex, sort of on the east side of town. Let's see, there's a couple of them in the Nashville area, and the guys that are running those two, there's a guy that lives in Nashville. I think very highly of him. And he is a very meticulous numbers kind of dude. I mean, he does spreadsheets out the wazoo, and I'm loving it when he does that kind of stuff. There's some that are just very technically minded, so he has a good mind on it, a good head on his shoulders for doing that kind of stuff. Let's see. There's a fellow that I met. This one was sort of nutty. There's a property in Arizona. We recently sold that one too. So two guys joined together. One was out of Toronto and one was out of somewhere in South Florida. Yeah, I'm going to say Miami, but I'm not sure. I think it might have been Fort Lauderdale. Anyway, the two of them joined together, buy a property in Phoenix. I mean, that's like nuts right there. But essentially, that thing did really, really well. But I knew one of them fairly well, and I liked him quite a bit. And I said, okay. And so I've gotten into two more properties with him since then. So it's just you start meeting people that they have a reputation, they do well. I have done it with a lot of new people, but I always look for a person who I know their sponsor because I know the group they can go back with to get the help. It has worked out most of the time. I've got one that perhaps I would argue a little bit right now is not doing all that well because we're a little upset with him and he's not doing great, but I've had really great results with them. The highest returning property was a couple's first property. She was an account rep at a brokerage firm, and he worked for IBM. So, I figured they had a little bit of financial and business knowledge. They had a glint in their eye that they're going to win at this business, and they have done very, very well. But that property is my all-time high returning property. So, Shazam! You roll the dice and you bet on a winner, and it goes off. But the dignity and the integrity of the person. I met one guy. He was a former banker. And you're looking at the clock. Don't look at the clock. I see that. Anyway, he's a former banker, and he sounded really good and all that. He bought a property down here south of Fort Worth. Cleburne, I believe, is near Cleburne, and it did very, very well. So you meet the person, and then you sort of depend on that person to do a good job. Like I said, lazy person can't do much after he's in the deal. He gets the choice to get in, or he gets the choice to not get in. Once he's gotten in, he sort of has to ride that horse all the way across the river, so to speak. There's no changing horses at that point. Well, there's almost no changing horses at that point. So, you're really stuck in the deal. And if the guy turns out to be not so good, then you sort of have to just remind him to be better is all you can do. That's about the extent of your capabilities. We did have one episode. I guess this is the time for a horror story. We had a guy lost focus, and we ultimately pushed him out of the deal and replaced him with another fellow. And it turned out, we didn't make nearly as what we thought we would, but we did okay. This was in the early days. It actually was the first property we invested in. He went for about 18 months doing just fine, and then, went south. And we phrase it as he lost focus. That's about all I can say. He lost focus, and he lost focus really good. So, we were auguring into the ground. We stepped in, threw him out, and one of my cohort in the cabal took it over. Like I said, I'm a lazy person. He wanted to be a big noogie in this business, and he is. So he took it over, ran the property very well, and pulled it out, pull back on the stick, if you will, if you want to do the airplane kind of analogy. And we came in for a nice, safe landing after that. So it worked out very, very well. But, so I've had all sorts of fun experiences. Some of them just sound terrible, but I'm still doing it because it is somewhat lucrative, and you just work problems when you find them. Every deal, almost every deal has had bumps and thuds along the road. And I can do another horror story if you like. If you want to go another route.
Yeah, let's hear it.
So we buy this property right before COVID. It's over in, I'm going to say Longview, but I always get Tyler and Longview. I'm not sure which city it was in. So we buy this thing. COVID kicks in. The banks dry up. And, the plan was buy it, take some loan money out on top of that to fix the place up. No loan money. So the lead calls me up and says, "Hey, Charles, how about you loan me some money?" So I did. I loaned him at an outrageous rate, or at least it was outrageous at the time. And so I loaned it to him for, I think it was right at 2 years. He fixed the place up. We sold it, and we ended up making, 25, 30%, some such nonsense like that. Plus he paid me back my money and the interest on the loan. So, was I upset? No. And we saw no distributions during that entire two and a quarter years. I can pull up the real numbers if it's important, but by and large, there's deals that just, you don't see any money during the time, but to be an LP, you probably need to have a good sleep regimen where you can sleep through things like this. It's just the way these things work. But, a certain level of, I expect things to go wrong. You deal with the problems when they go wrong, and you just work them. It's not a huge problem.
Charles, I appreciate you sharing your stories with us. When I talk to people about investing in deals, I generally break it into three things: the deal, the market, and the team. And when I asked you what you look for, you just spent quite a bit of the time talking about the team, or the jockey, as you called it. And yep. I think that really says something about what passive investors should be focusing on when they're looking at investing in a project, because the people that are operating it, this is a people business. Real estate is a people business. If you don't know that, real estate is a people business, and making sure that you are invested with a team that is able to execute on what their business plan is huge in being able to bring the returns that they project, just like you're talking about with some of those stories. Luckily, it sounds like even when it didn't go well, it still played out decently for you.
Well, so I've got some ones that didn't. There's one I lost money on, lost $5,000 out of 100, so nothing tragic.
That's not terrible.
No, I have a worse story that I wasn't involved in, and a friend of mine put in 75, got back 17. So, that's a much more tragic experience that I was not firsthand on, but University of Hard Knocks is much better when you audit the course and let somebody else pay for the course.
Yes.
But, you mentioned the location. Location is a huge piece of it. You're right. And the demographics, huge piece of it. But if you've got a person who's doing this, they're not going to go somewhere where it's stupid to go. So, that sort of takes care of itself if you've got the person down. You think highly of them. They know what they're doing. So yes, I'm not going to invest in some places. Detroit is not on my list. We eliminate places like that immediately. We don't do states that are inconvenient. New York, California, not going there. It doesn't happen. So, you eliminate a whole lot of the location. Now, bad parts of town, yeah, sometimes you get into a part of town that's not wonderful, but we're usually doing B and C property. So we're probably not going to be in the Highland Parks. That's a went back to my childhood. That's a Dallas reference. We're not going to be in Belle Beat if you want to go to Nashville. We're not going to be in Buckhead if you're going to go to Atlanta. So, we're going to be in a place that's sort of mediocre on these things because we're buying workforce housing. Typically, we make some money. So no, I'm not going to move into the apartments that I end up buying on these places, and you have to recognize that. You didn't even that you have to hold your nose. You have to realize that you're providing a good, safe living space for people who need it, and they're going to pay a reasonable price for a reasonable product.
So, Charles, you have a ton of experience, which is being shown here, and I appreciate that. Some of our listeners are not as experienced as you are. So when I say deal marketing team, the point is there's a lot of things you should be considering when doing a real estate investment. If you want to do it on your own, that's fine, as long as you understand the pieces that are involved and you're able to have some type of experience or mentor coaching you on what you should be doing. And if you don't have that, there's a possibility you could lose money. Like you've got that horror story of somebody losing almost, what is that?
I can't do
70%. Yeah, it's not a good return.
Yeah.
About 75%. Yeah.
Yeah.
So,
Roger, go ahead.
No, I was just saying I can't do that math in my head that fast because it's weird numbers. But yes, I'll accept the number. Go ahead.
We know that you have another appointment in 10 minutes. That's the only reason I was looking at the clock, Charles.
Okay.
Roger, I'm kind of out of questions. You said you had some you wanted to do at the end?
Sure. What are some of the red flags that pop up when you look at deals that you won't invest in?
I've seen people do student housing. I don't like student housing, so I personally avoid that. My wife and kids, we have our own LLC. They don't like hurricanes, so we don't really do Houston. There's, if the guy, it goes back mostly to the person. If the guy's a little flaky, I won't get in it. I've walked away from a deal I was interested in when the operating agreement and the PPM don't match. I find that to be a little suspicious. They can't get their numbers. I almost walked away. My buddy in Nashville, he put this deal together and it had this dead spot in there for the investors. And I was about to walk away and then I did the math and I said, there's no dead spot. The guy's wrong. And by that, it is a catch-up. It's called catch-up, where the GPs pay the LPs a certain amount, and then for a period of time, only GP money comes out, and then it starts up with them sharing money. Well, mathematically, or in the documents, it was in there, but mathematically, it didn't exist. It was I don't know, an appendix kind of thing, or a vestige of some mistake the lawyer put in, or something like that. And the GP was sure it was in there, and he finally called the lawyer and says, no, it doesn't really exist. It's just in there, verbally. It doesn't, so I invested in that. I guess that one's doing okay too, but it was just weird kind of things like that. I'll look through the paperwork. You need to learn to be able to read the PPMs and the OAs, operating agreements, private placement memorandum, for those two definitions.
Thank you, Charles.
Okay, no problem. Let's see. Other things that I don't like. I don't like tiered deals. I pretty much think dollar's worth a dollar. Now I realize, if you put in a lot of money, maybe you are worth getting a little bit more back. But I typically don't put in the highest amount all the time. I'm not that well heeled, so I prefer deals that don't have this tiered thing where they have different returns for different amounts put in, because it's very confusing. It's called the waterfall. And when the waterfall gets really crazy, I try to walk away from them. I don't like anybody with a disposition fee. I don't really like acquisition fees, but I realize that they're becoming more and more popular. And by that is essentially an acquisition fee looks like a front-end loaded fund where some percentage of your money goes off to the company instead of going into your investments, and a back-end loaded fund is like a disposition fee. where a certain amount of the money that you would have gotten goes off to the company instead of going to you. And, the disposition fee, and this is my humorous way of putting it, like they buy this property and they're running it, and all of a sudden they remember, oh, we're going to sell it. We had to charge a fee for that. We never thought about this selling thing. That's a complete surprise to us. What the hell? Yeah, let's sell this thing. Sure. Yeah, charge them money to sell it. Never considered that before. It's like, wait a minute, guys. Come on. That's part of the deal. You're going to sell it. Just take that as your part of the cut. Anyway, so there's some fees I will avoid because I just think they're a little bit crooked. And they're not crooked exactly. I will say that GPs earn what they make in so many ways, unless they're just outrageous. I have a friend, he was buying a building. I was invested in the building. It turned out the deal didn't close. I got all my money back and he lost $1 million on the hard money. So, they take risks that I don't take, and I recognize those risks. So I'm willing to pay them their cut and their some of their fees. There's just some that I just don't think are reasonable. So, as a GP, who thinks that I ought to get everything, that's wrong. Those guys take a risk and they deserve to be paid for that risk. And I recognize that, but there's a limit to how much I'm willing to recognize what they get paid for that risk. Apologies to anybody I've offended on that one.
Well, there are like 9 or 10 fees that a GP could charge, and most of them, in my opinion, are excessive. So yes, make sure you're looking at the PPM when you're investing in a deal so that you're not paying 10 different fees.
Figure out where the money goes and when. There's this waterfall thing, and they can jury rig it where you're not going to make as much as you thought you were going to make. There was a deal. A fellow out in California was putting together a residential assisted living deal. We were all going to, if I'd gotten into it, which I did not, we were going to fund the down payment. We were going to make a cut of the thing. He was going to pay, I think, a 16% return, and then he was going to buy us out. And everybody on the call was used to the model where you split the outcome. But I can read, I can hear, I understood what he was talking about. And they keep asking, well, how much of the gain do we get in the end? How much, they couldn't quite grasp or wrap their head around the fact that the dude was taking all the profits. And so I don't know how it all worked out. I was just laughing to myself on that one. So, be aware that there are different ways you can fund these things. Some of them are debt that look a little bit like equity, so you can play games with the capital gain taxes on it. Some of them are actual equity. There's a lot of things they can pull, and I don't mean they can pull. They're up front. If you're not listening, you can get tricked. There's, like you say, all sorts of fees. Some of them, the buyouts at the end where they take all the profits. I'm not a big fan of that. I mean, let's play the game and split all the way, or they say, past a certain point, we're going to take a bigger amount. And I'm going like, well, how about below a certain point, you take a lesser amount? They don't usually go for that one. So, it's I like a fair deal. I like a straight cut. A pref is so much better sometimes. Our group typically doesn't do prefs. It has not come back to bite me too much. But sometimes a pref is very preferable. But, don't be confused that a pref means they're paying you. It ain't happening.
Charles, give us the definition.
Oh, okay. You get into a deal. There's a thing called cash on cash. I put in $100,000 and I'm expecting to make a 10% cash on cash. Oh, I wish. But that means that they're typically going to pay you 4 payments of $2,500 so that you make $10,000 during the year if they make a profit. Well, a pref says that you might say, oh, he's got a 10% pref. Well, it's no better than that cash on cash. They may or may not pay it. They're not saying we're paying you 10%. They're just saying if we don't pay you 10%, we will make it up later. And there's a maybe on that because sometimes they have a non-cumulative pref, which means absolutely nothing. So, do read the PPM because they can say, oh, we got a pref. Sure we do. Wink, wink, nod, nod. And it's non-cumulative. Well, if it's cumulative, in theory, they, at the end of the deal, when they sell it, they have to make up all the money they didn't get out to you, and then they start taking their cut. So there is that, and so in that sense, the pref beats the model that we typically go. But my group typically charges or takes a lower split. And mathematically, in certain ranges, the pref wins. In certain ranges, the lower split wins. And so I'm willing to play the game the way we play it.
Charles, I appreciate your humor there, and you're demonstrating your knowledge as a sophisticated investor. So thank you for sharing those thoughts.
You can go a little longer. I'm not proud. If you're getting something out of this, I'll go for a while.
Roger, did you have other follow-up questions?
Yeah. What's your favorite investment vehicle? I'm guessing it's going to start with a Roth, and it might be a solo 401k, but what is it?
I'd do it with regular money. Would you say favorite? I unless it's a Roth solo 401k, it gets bitten far too much for me to believe it's good. Now, there are people that are out here that only have that kind of money and they want to get into this. My 2 cents, and I have some friends that are financial planners, and they hate me for this, but I tell people, get the match. And if you have a penchant for going to an alternative investment, be it real estate, I don't know, or any of the ilks like that, start putting your money in a brokerage account outside that Roth, because that's the money I think you ought to put in real estate. If you go through an IRA, you're going to get hit with that extra tax, UBIT, UDFI, whichever way you want to call it. And, it becomes painful. And plus the fact you have a real trouble finding an accountant that actually understands it correctly. I've got a couple of horror stories where the accountant, my accountant was arguing with me that it didn't exist. And I have a friend whose accountant just said, we can't do this for you, go away. So, it's hard to find accountants that understand real estate. Got a good one now, you guys done me some really good things, but, it's painful to do things through an IRA. It's very easy to start, but once you sell the thing with inside that IRA, then you start having these issues. So I would say do it through real money.
Going back to what we were talking about before too, Charles, taxes are confusing, and making sure that you have somebody on your team, whether it's an accountant, CPA, whatever you want to call them, that understands taxes is huge in you growing your wealth properly.
Oh yeah. And there's all sorts of misconceptions, and we don't have nearly enough time to go through the misconceptions of how taxes work. But, it is a graduated system. Yes, if you have a marginal income tax rate of 24%, you're not paying 24% on the whole amount. It's only the next dollar you earn and the last dollar you earned. It's at the 24% level, although it might be several dollars. So, just be aware of how taxes work. It's I realize that math was a shunned subject in high school, college, and whatever. My wife hates math, but it is not the end of the world. I mean, this is not brain surgery. It's tree surgery. You really can understand it if you put a little effort into it.
Agreed. Roger, you got more thoughts?
Nope.
Charles, this has been great. We've answered all the questions we had lined out here. Is there other stuff that you would like to share with our listeners? Pretty open-ended question there.
Yeah, I was going to say, cross the boundary into retirement with as much as you can for your social economic position. I mean, and I don't want to pick on anybody. I have no idea what garbage collectors make, but, as an engineer, I had a pretty good salary, not nearly as much as the CEO of the company. So, my standard of living was nowhere near what his was. And my standard of living was probably better than, I'm trying to think of somebody I can pick on. The guy at the grocery store, I'll just pick on him right now. So, you can cross the boundary and have your standard of living continue through retirement if you save a reasonable amount. I as an aside, and also humor because I take life this way, these dudes who were trying to sell me insurance as I was graduating from college, and they were, giving me all these facts. And so I just asked them, well, how much do I have to save to be like Bill Gates? And that shut them up. They left me alone after that. But, it's just, you cannot have the expectations of being the Bill Gates when you're the Charles LeMaire. And the guy at the grocery store has to have, his expectations of continuing with his lifestyle. He can't necessarily be the Charles LeMaire. So, don't feel like we all live at the level that we live at. We're given the same opportunities. And if we take them, we take them. It's not an outcome game, but you need to save what you expect to be there when you're in the end. And I don't want to go political, so we'll leave that alone. But essentially, you need to be ready for that, and you need to have as good an understanding of how it all works. I can't say that Social Security will last forever, but I went into a great deal of effort. Let's see, you start at 62 as the possibility. So around 51, 52, I started studying Social Security so I could understand it. My goal was to know as much of it as the woman who sat across the table and was lying to me when it came time, because they will, not intentionally. They're pretty straightforward folks, and I really had a reasonable time on the 3 or 4 visits I've had to the Social Security office. But it is super confusing, and if you don't have a clue about their language and their discussion, their jargon, you're just not going to get the deal that you should have gotten. There are, they say there's 96,000 ways to pick Social Security, and I think there's actually more than that if you look at about a married couple. But if you don't understand how it works, you're not going to optimize what you're going to get. And everybody says, well, just go for 70. Well, that's a hard thing to do unless you've got enough money to make it to 70. And it may not be the right answer for you because there's reasons not to wait for 70. And then it used to be that 50% of people or even more used to take it at 62. That's dropping off now statistically. But, that's not the right answer if you're married, because you're screwing your spouse if you're the higher wage earner. There are just a ton of things to know about Social Security and how it works, and, how not to screw your spouse on the deal. So, and I can go deeper than that. I mean, I can get into details if you like, but, this isn't really that subject.
Let's not go too much further in that. What I want to comment on your thoughts there, Charles, is that your retirement is really your responsibility. You've put in a ton of effort, which shows, and other people that are listening should take that into consideration, that your retirement is on your shoulders. And there's information out there that's free. It's available. If you're willing to put the time in there and learn it, then it will benefit you greatly when you get to your retirement years. Is that a good summary there, Charles?
I think it is. I guess I'd like to add, learn the time value of money, how it works. $1 tomorrow is not worth as much as $1 today. Learn about, if you're going to do investing, learn what IRR and how it works is, at least conceptually, so that when people talk to you, you can understand what they're saying. There's the concept of cash flow is important, and that's what I'm all working for. There's sort of a current joke around, which is like $1 million or $50 a month for the rest of your life. And the foolish person takes the $50 because cash flow is not the winner in this one. So, understand, be able to do the math, even in your head, to figure out which one's better. The opposite of that is the take a penny a day. Will you take a penny doubled every day for 31 days, or would you just take $1 million and, the penny works on that one? So really, there's a lot of just clean understanding of math that helps you make good decisions. And I won't say I've not made bad decisions and bad investments, but gosh, golly gee, it's a whole lot better when you make fewer bad ones and more good ones.
But you've also put the time in to learn so that you fail less is probably the best way to say that, right?
The harder I work, the luckier I am.
That's a great line. Roger, do you have any other comments?
Nope.
Okay, Charles. One thing we ask everybody that comes on the show is how our listeners can find you online. The question I want to ask you is, do you want people to find you online? Do you want us to be giving away your information, or would you prefer to just skip that question?
I have no problem. If you put my email in there, is that I answer a lot of emails. I'm slow about it sometimes, but I don't maintain a web page. I'm not trying to get anybody's money. So, it's not like I maintain a huge presence trying to play the point of the shark. But, if someone's trying to get into this, I have no problem spending some time with them talking about it. Saturday, I spent a couple hours with a friend I used to work with because he's thinking about doing this stuff. I do that all the time. It is one way to give back. Like I said, I can't do umpiring or coaching. I'm no good at it. So I try to do something.
Well, thank you for that. I'm going to re-record the question. You just answered it, so just disregard what I'm saying. Charles, what's the best way for our listeners to find you online? And then our editor can throw that in the back. Okay, Charles, I'm just going to do a summary, and then we're going to have Roger close us out. Do you have anything else you want to say before we do that?
Roger, I hope you're feeling better.
Thanks. I've been under the weather since the whole weekend. Like Saturday was a good day, and then yesterday I didn't get out of bed, and today I only got out of bed for this podcast recording. So,
well, better through chemistry is what we like to say. So go find someone to give you good drugs.
Yeah, the problem is I have about 7 drugs, and the 6 I took today aren't helping me much. and the seventh one ran out of prescription. And so I need to find a new doctor that will give me that one. But here we are.
Hope you feel better, Roger.
Cool.
All right. Just as a quick summary for our episode today, we learned quite a bit from Charles. He was talking about IRAs, 401ks, and the benefits and challenges with using those in your investing strategy. We also talked about his experience investing in real estate and how that's helped him grow his wealth, and something that you should be considering as if you want to be a passive investor. And when you are considering being a passive investor, there's many things that you should be looking for with the team or group that you choose to invest with, so that you can make sure your investment does produce the returns that you're expecting. We want to thank Charles for being on the show today. Thanks for being here, Charles. Roger, if you want to close us out.
Sure. Thanks, everyone, for joining the Retire Wealthy and Happy podcast today. We'll see you next time.
Hope you got value from this episode. And if you have a minute, then take the time to leave an honest written review for the podcast, because we take those reviews seriously, and it'll help us serve you better on the next episodes. And most importantly, be sure to start taking action so you can control your financial future today.